Hi, and welcome back to Stop Being Sold. My name is Michelle, and I'm here with Brian. And in today's video, we're discussing whether or not fixed indexed annuities can be used as a hedge against the stock market.
Yeah, Michelle, with the volatility that we're seeing in the stock market,
Yeah.
it's understandable that a lot of investors are looking for ways to protect their portfolios and limit their risk.
Yeah.
And fixed indexed annuities, or FIAs, may help investors do this.
So before we dive into the details, let's define fixed indexed annuities to make sure we're all on the same page.
Yes, we've talked about many annuities on our channel here,
Sure.
but the fixed indexed annuity is a contract with an insurance company that tracks an index like
Mhm.
the S&P 500. That's the most popular one, right? And it pays you interest up to your declared cap or your participation rate. You have zero downside risk, but also, though, you have limited upside potential up to what the cap is or the rate is that's declared in the product. So,
Okay.
some of the reasons that someone would buy a fixed indexed annuity is to earn more than typical savings rates, limit their losses in the stock market, and participate in the gains of an index up to the caps or participation rates. So,
Got it. Okay. So because there is zero downside risk and some upside potential with a fixed indexed annuity, this is how it can be a hedge against the stock market, correct?
yeah, because you want to be in the market, but you
Mm-hmm.
don't want the risk of the market. And so you get to participate in some of the upside potential of the market. So, and think about this. I've seen many investors use like a 70-30 strategy. We've always heard the traditional 60-40
Sure.
stock bond split. They've talked about that for decades, right? I've seen investors use a 70-30 strategy with fixed index annuities and the stock market. And
Got
here's how
it.
they do that. Let's say you had a client that had $100,000 to invest. They
Mm-hmm.
would split up it by buying a $70,000 indexed annuity and put 30,000 into the actual stock market.
Okay.
If the stock market dropped by 20%, let's say this year it dropped by 20%, they would only be down 6% of their total portfolio. Why? Because they only put 30,000 in the market times 20% down is a 6% loss. Their other $70,000 that was in the indexed annuity would just get a zero for the year. So their total loss would be $6,000.
Sure.
Now, if they would have taken that whole $100,000, Michelle, and
Yeah.
went into the market with it, they would have been down the full 20% or
20
$20,000.
grand. Right. Okay. So does this work? I mean, it really is about the 70-30 strategy. So this does work with smaller amounts, right? The
Oh,
example you gave is
yes.
100K. So
Yes, definitely. Definitely. Just split the amount in whatever amount is like a 70-30 ratio. So if it's 50,000, 30,000, 25,000, whatever it may be, just split it up.
okay, so here's a question. How long typically are fixed annuity contracts? I mean, the duration of a contract might be something people should be worried about if you need
Sure.
like liquidity, right?
Yeah, liquidity would be the number one. But let's start with your first question. Contracts on the index annuities, Michelle, you'll see them ranges in 5 years up to 16 years, depending on your state. I'm here in the state of Texas. Texas only allows a 10-year indexed annuity.
Got it. Okay.
So if you need access to the funds earlier than the term of the annuity mature date, you will have to possibly pay a penalty for the
Yeah.
withdrawals because you've taken money out past what the free withdrawal allows.
Okay, got it. So is there anyone the strategy isn't right for?
Yeah, well, like I just
Like,
said,
yeah,
it's not for somebody that needs funds in the short
sure.
term or even somebody that's totally risk adverse. And what I mean by that is
Mhm.
30% in the stock market still may be too much for their risk tolerance.
Sure.
So all goes back to the individual.
So, okay, one last question
Mhm.
that I have is, so if sometimes we think that we are okay in terms of like, okay, I've got some cash sitting over here, but something then happens. Is there, you mentioned, if you need the cash, this is obviously not right for you. What do you say to people who maybe have $50,000 in cash sitting on the sideline? You wouldn't tell them to, you put all of that in, correct?
No,
You keep some
no,
liquid.
definitely not. Definitely not. Number one priority in my years in the industry, going on 25 years now, is emergency savings first.
Yeah, right.
It's that simple, because no one can tell us what tomorrow is going to do. No matter how good something sounds,
Exactly.
you still have to be prepared for what may come at you tomorrow.
Sure. Sure.
Texas, for example, Texas was not prepared for the 100-year ice storm that
Right.
hit us a year and a half ago, right?
Right.
And that decimated billions and billions of dollars of losses. People weren't prepared for
Sure.
that. So,
All right. I think that's a good note. Get an emergency fund. This is not what this video is about, but that if you don't have one, get one. Don't invest everything. All
right.
right. So if you like the content of this video, make sure you hit that like button, subscribe to the channel so you don't miss another video from us. And also, we're going to put in the pin comment below and below this video. We did an entire series on annuities exposed, and we did one specifically on fixed index annuities. So my recommendation is to go check that out. Because even if this sounds like a great idea, you do want to know the ins and outs and everything you need to know about a fixed index annuity before you sign on the dotted line. Right, Brian?
Yes,
read the contract.
Read the contract. DYOR. Do your own research, please.
Exactly. All right. Well, anything else you want to add, Brian, before we wrap up the video?
No, that's it, folks. Just these could be used as a great hedge to your stock market portfolio.
Awesome. All right. Thanks, Brian, and thanks everyone who watched.
Thank you.